Well, I think you're basically you're looking at an economy that's a train wreck in motion.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me on again, Elijah. I always enjoy being on your show.
Definitely. Now, the first topic I'd like to discuss is the gold and silver markets. I know last time we had you on, which is about 3 or 4 weeks ago, you were looking for one more movement down. We haven't seen that yet. So where do you think we're headed?
Yeah, I was looking at that. I think when we recorded that show for metals and markets, it was kind of midday on Friday. And I hadn't looked at the COT report yet. In fact, I didn't really look at the COT report until that weekend. And I was kind of shocked at how quickly the open interest and kind of the net short position of the banks and the net long position of the hedge funds had come down. And we actually took off the hedge that we put on our junior mining stock portfolio the following week. And we kind of, rode the rest of the month out unhedged. But we actually put the hedge back on yesterday. So I think kind of what happened, that, like I said, the open interest dropped a lot more quickly than I had anticipated, because I don't go by moving averages and what charts look like. I go by the commitment of traders open interest, because that's the nexus of the manipulation is the COMEX. And up until that point, the numbers in the commitment of traders report was telling me that they were going to try and take gold lower. I think part of what might have happened is that the amount of physical demand, the amount of gold that flowed into India and also into China in the second half of December was a lot higher than anyone anticipated, at least based on the numbers that I have access to. And I think that supported the market. And I think also there was kind of a mindset that, oh well, January is a seasonally good month for gold. I know, blogs like Zero Hedge were posting a lot of articles about, the January effect on gold. And I think a lot of that got priced into the market in the last half of December. So, on the flip side of that, the open interest on the COMEX has shot up quite a bit very quickly, more quickly than normal. In the first week and a half of January. And, as of the last commitment of traders report, I kind of thought that the distribution between the net short of the banks and the net long position of the hedge funds is starting to get unbalanced again. And so my partner and I decided to put our hedge back on our fund yesterday, and what we saw today, the hit on gold is kind of what I'm expecting. Although again, it's to me, gold also bounced back in the second half of the day. It still ended down on the day, but kind of at this point, I'm sort of scratching my head. I think that the banks have a short position that requires them to take the market lower in order to book profits on what they've put on in the last week and a half, 2 weeks. On the other hand, it seems like the investor demand for paper gold and physical gold and silver has picked up quite a bit. I also think that there's been this theme that we'll see inflation tick up in 2018. We're already seeing it in all just commodities in general. Commodities, whatever commodity index you want to look at, is up quite a bit in the last month. And I think part of that is from all the money that's been printed by the central banks is going to start manifesting in an acceleration of price inflation. We've seen the acceleration in housing price inflation and stock price inflation, I think we're going to start to see an acceleration in price inflation on just general goods and services that people need to spend money on every day. And that is an environment that, I mean, that's like a perfect recipe for gold and silver. And so regardless of the degree to which they are going to try and manipulate gold and silver lower, at this point, I'm not expecting like a real washout like we've been used to seeing since 2011.
Okay, so it seems like you're saying we might see a little gold and silver go a little bit lower, but do you see them going below the lows we saw last time? You know, like gold going below 1250?
No, and again, I'm not a big chart guy. So I try to. I mean, I obviously look at charts like everyone else. You have to, because to the extent that everyone or a lot of funds and a lot of traders trade off of the charts, they kind of become self-fulfilling prophecies. So you got to pay attention to them. I mean, I'm really more about focusing on a longer-term view and on fundamentals. I mean, if you look at a chart right now, I'm looking at a 1 year of gold. It looks like gold is kind of, I mean, it's had a sharp move since sort of, you know, early December, and it looks like it might be topping out a bit here. I mean, the technical indicators are rolling over from a technically overbought level. I think a pullback would be healthy. If I was a pure chartist and I was going to look at this, I'd say, yeah, we could potentially get a pullback to 1280. You know, the last time around, I was looking for a pullback to the 1230 to 1240 area, and I think we went below 1240 intraday on one of the days, and we closed a little above 1240 for a couple days, and then that's when the market took off. So, you know, to the extent that speculative excess is kind of built up in paper gold and GLD, you know, over the last 3 weeks, I would actually welcome a price correction here. Whether or not we're going to get it remains to be seen. Again, I really don't like to put outright forecasts on where I think gold's going, just because the market's so manipulated, it makes true price discovery impossible.
Now, moving to the stock market, you recently wrote an article where you say that bullish sentiment of investors continues to soar. Do you think this is a red flag?
I think it's absolutely a red flag. I was reading an article earlier today, and it's a subscription newsletter that I get, and the guy was citing data from Charles Schwab that showed that investor cash or client cash levels as a percent of total client assets is at a record low level, and it's well below the cash level that was seen right before the tech wreck in 2000. And I like to use, you know, investor cash level. A cash on the sidelines, who knows what that means? If Charles Schwab is reporting that their cash levels are at historically low levels, that means that you're talking about the average retail investor. And that also means that the same thing's probably true at Ameritrade and E-Trade and whatever, you know, other online trading brokers that retail investors like to use. I use Schwab, and we use Schwab for the fund, and we use Fidelity. So, you know, you're talking about just pure population statistics here. So if retail cash levels are at historically low levels, it also means that retail enthusiasm and bullishness for stocks is at historically high levels. And, you know, again, using history as the yardstick here, that's when you get at points like that, that's when you're approaching or have reached a market top. Now, that doesn't mean to say we'll sell off tomorrow. It's a process. And you've got a bunch of other factors that are present now that might not have been present, you know, in the last several cycles, not the least of which is central bank intervention to keep stock prices propped up. So I do think you're going to reach a point where all of a sudden the selling stops, and there's no one there to bid on the stocks, because you've also got there's a record low level interest in short selling. And I mean, interestingly, the subscription base in my short sellers journal has actually increased over the last 2 months. I just had a new subscriber yesterday, and I've lost very few. So I think that, people who understand what's going on and who are, short selling is probably for a slightly more sophisticated investor. And these people, I think, are just biding their time and waiting. But to the extent that short interest is at a record low level in the markets, and conversely, margin debt is at an all-time high in the markets, when the selling starts, there's going to be a lack of bidders out there to buy what's being sold. I mean, historically, if you've had a lot of short sellers and a decent short interest in the market, at some point, people who are short start taking profits. They're not going to try and downtick the market or bottom tick the market. So that element of buy interest, once the market starts downward, is not going to be present this time. So, I don't know when it's going to happen. I mean, it could be now, it could be 3 years from now, but at some point, I think we're going to see a very, very abrupt market adjustment to the downside.
Now, what about the auto loan market or the auto loans? Because I know you also wrote an article on this, and not only a stock market collapse you see happening, you also see a subprime auto loan collapse coming.
Yes. Well, I mean, it's already bearing out in the numbers. I study this, every week because it's I include it in part of my economic and financial analysis in my short sellers journal. And I happen to notice, I want to say as recently as 3 or 4 months ago, that the delinquency and default numbers on subprime auto debt. So subprime would be defined as, below a 620 credit score. The delinquency and default rates on subprime auto debt is now at levels that was last seen in late 2008. So, and we haven't had a quote unquote financial crisis yet. So the levels of default and delinquency that you saw in 2008 were after you had the market crash. The housing market had already taken a big hit. So, I mean, imagine how bad it's going to get this time around, because now you've got not only a record level of auto debt outstanding, you've got a record level of subprime auto debt. I mean, I don't care what, the banks are going to tell us or the Fed tells us. They're saying that subprime is about 20% of total auto loan issuance. And I would argue that it's probably closer, it's over 30%. It may be as high as 40% because the lending standards have become so lenient. And you've seen a lot of the lending fraud that was going on in the subprime mortgage market in the mid-2000s. That's been showing up in auto loans. And you look at things like, there's 108 million auto loans outstanding. It's probably higher now. That number is a little bit dated. And the average loan balance per auto loan is almost $30,000. I mean, that to me, that's just a mind-blowing number. And this is debt that ultimately is not going to get paid off. I've been hearing a bunch of anecdotal stories of the repo rate ticking up in the auto market. And I think as the average household, as they see their income get squeezed from higher Obamacare premiums, higher inflation, stagnant income growth, just higher general debt levels, they're going to stop making payments on credit cards and auto loans and things like that.
Now, one of the things that you've also discussed is how basically with all these risks inherent in the system with the subprime auto loan, it seems like those are going to be collapsing, and also the stock market. There's a lot of propaganda news out there trying to make people think that the economy is actually doing well when it's not.
Yes. I mean, for instance, they reported that jobs number on Friday, and 148,000 jobs were created supposedly in December. It missed expectations by quite a bit. But if you go and you scrutinize the numbers the number of people who have multiple jobs increased by 305,000. So what that tells you, okay, is that net, I mean, the 305,000 people who took part-time jobs, I mean, those are part-time jobs. You know, you don't take multiple full-time jobs. You take, you know, if you have multiple jobs, you're taking a part-time job. So those 148,000 jobs that were created, subtract 305,000 from that, and that's how many full-time jobs were lost. So the quality of the jobs, if they are in fact even really being created, the quality of the jobs are not, they're not high quality, high paying jobs, you know, the type of jobs that people need to get to make ends meet. And that's why in the month of November, the amount of consumer debt hit an all-time high. Credit card debt hit an all-time high. It exceeded the record in 2008. And for the month of November, the amount of credit card debt for any month went up by a record amount in history. And that's because people have to use the revolving credit to make ends meet now. So, you know, even though the financial media puts their spin on the job reports and ADP payroll report and things like that, it's if you look beneath the surface, it's not what it's being represented to be. And so that's an example of, you know, the high degree of propaganda that's being floated out there by DC, by Wall Street, and by the financial media to kind of make people think that, oh, well, you know, things are great now, or things are getting better. There was a consumer sentiment report I saw, I don't know, it was a week ago or 2 weeks ago, and the current conditions were at a record high. Everyone felt great about what was going on now. It's the holiday season. You got this tax cut that is not going to help anyone that's in the middle class bucket, but everyone felt great about it anyway. You know, there's hope that it will give them some relief. And yet the index for future expectations literally crashed, and the spread between current and future expectations, I think on a relative basis, it was one of the highest spreads that we've ever seen. It was certainly the type of spread between current and future expectations that you see before the economy goes into a deep recession and the markets crash.
So then what does that say for us going forward?
Well, I think you're basically you're looking at an economy that's a train wreck in motion. You know, you've got general economic deterioration going on beneath the headline propaganda. I mean, it's already been proved that, you know, you've got the income distribution is skewed at a historically high level toward the upper 1% and the upper 10%. The average American is not participating in this stock rally other than if they've got a pension fund that is going to be completely bankrupt by the time the average worker is ready to take retirement. I think we're looking at a slow motion train wreck here in the entire system. And the only reason it's slow motion is because the Fed's doing what it can to keep it propped up. I mean, I was looking at some numbers earlier today. I was going over some numbers with this, you know, with someone. We were talking about, oh, well, is the Fed really deleveraging its balance sheet? And if you look at what is known as its SOMA account, and that's the account where it bought bonds, mortgages, and treasury bonds that were part of what, you know, the so-called QE program. Well, yeah, since the beginning of or the middle of October, that the SOMA account is down about $19 billion. And so that's roughly on track with what the Fed said they were going to do beginning, you know, to start off their balance sheet reduction, you know, about $10 billion a month. Well, the thing is, if you look at the overall size of the Fed balance sheet, the overall size of the Fed balance sheet between the end of October and now, the last time it was reported was, I think, the end of the third week in December or the middle of the fourth week. The overall size of the Fed balance sheet increased. So that tells you they are, you know, keeping that safety net at a high level below the financial system. So, you know, to me, it remains to be seen whether or not there's going to be any deleveraging. And the other thing that I looked at was the excess reserve account for the banks. Well, the excess reserve account for the banks has increased over the last 3 months. The excess reserve accounts is the bank accounts held by the Fed. That was the where most of the QE money that the banks held on to, it went into the excess reserve account. So that's one of the things that I look at to see if the Fed's actually removing liquidity from the system. And as it turns out, they're not. So, you got on one hand the headline propaganda, oh, the Fed's going to reduce its balance sheet by XYZ amount this year. And, at least up, through the first 2 months that they were supposed to be reducing their balance sheet, not only have they not reduced it, they've increased it, and they've showed no signs of removing liquidity from the system.
All right. Well, David Kranzler, thank you so much for joining us today. Before we let you go, are there any last thoughts you'd like to add, and where can our viewers find you online?
Sure. My website is investmentresearchdynamics.com, and I try to post a blog post. Lately, it's been about every other day. I try to look. I either try to repost something that I think is interesting to read and should be read, or I try to come up with original material. And then I also have links there for my short sellers journal and my mining stock journal. I will say that, again, the variables that I would watch besides the Commitment of Traders report is watch the dollar, because the gold was going up while the dollar was getting hit. And I think if the dollar loses the kind of 90 to 91 area on the dollar index, you're going to start to see fireworks in the precious metals market. And even if the dollar trends sideways, notwithstanding short-term technical things like, the net short position of the banks, and what the banks might do over the next 3 or 4 weeks, I will say that because of the fundamental deterioration going on in the economy and the deterioration going on just in the general financial system with credit delinquencies and defaults picking up, et cetera, I do think the Fed at some point, we've already seen a few Fed guys come out and say, oh, maybe we don't need to raise interest rates as quickly as we thought we did in 2018. So you're already seeing the Fed backpedal on tightening up interest rates and tightening up monetary policy. And to the extent that that happens, I think it'll launch gold. I had a meeting with an executive of a mining stock company that it's a junior exploration gold company with a potentially huge deposit in Nevada. And he and I both kind of agreed we expect to see gold go over 1,400 in 2018.
All right. Well, David Kranzler, once again, thank you so much for your time today.
Thanks for having me, Elijah. I appreciate it.